The proposal to integrate Bitcoin into the United States strategic reserves marks a significant deviation from established norms. Traditional reserves such as oil and gold serve tangible and immediate national interests. Bitcoin, by contrast, functions as a digital store of value with no direct utility in crises. Its inclusion in national reserves would signify a shift from tangible resource management to speculative financial experimentation. Strategic reserves are built on predictability and control. Bitcoin offers neither. Its fixed supply and decentralized governance structure make it incompatible with the Federal Reserve's monetary tools. The U.S. government cannot alter Bitcoin's supply, adjust its inflation rate, or intervene to stabilize its value. These characteristics introduce vulnerabilities rather than resilience into national planning. Bitcoin's core design, decentralization, is its greatest strength and weakness in a national context. Unlike fiat currency, it is immune to direct manipulation by central authorities. For libertarian-leaning investors, this represents freedom. For government planners, it's a liability. U.S. financial policy relies on central tools such as interest rate adjustments, quantitative easing, and money supply management. These tools enable policymakers to respond swiftly to inflation, deflation, or financial crises. Bitcoin's decentralized ledger and fixed issuance schedule strip policymakers of those levers. This structural conflict makes integration into national reserves not just impractical, but strategically contradictory. The lack of centralized control also opens doors to price manipulation. Large Bitcoin holders, or whales, can exert significant influence over market value. This dynamic introduces volatility into a system that typically prioritizes stability. Moreover, Bitcoin's value is subject to market sentiment, social media narratives, and speculative trading, further distancing it from the stable foundations national reserves are meant to provide. Beyond conceptual misalignment, the operational difficulties of adopting Bitcoin at a national level are formidable. The U.S. financial system is built on regulation, compliance, and centralized oversight. Banks, financial institutions, and government agencies adhere to strict reporting standards, anti-money laundering (AML) frameworks, and Know Your Customer (KYC) laws. Bitcoin's pseudonymous architecture challenges these frameworks. Transactions on the blockchain may be transparent, but they are not always attributable to specific individuals or institutions without forensic tools. Implementing robust AML and KYC oversight on a decentralized platform would require massive infrastructural reform. These reforms could take years if not decades to develop, test, and enforce. Additionally, national adoption of Bitcoin would necessitate new tax policies, audit mechanisms, and banking standards. These requirements place further strain on federal and state-level agencies that are already stretched by existing financial oversight responsibilities. Perhaps most significantly, adopting Bitcoin as a national reserve asset carries geopolitical risks. Several U.S. adversaries already utilize cryptocurrencies to circumvent sanctions. By legitimizing Bitcoin, the U.S. could inadvertently bolster these strategies. For example, Russia has turned to crypto to reduce its reliance on the SWIFT system. North Korea reportedly funds its weapons programs through cyber theft and crypto laundering. Iran leverages domestic mining operations to generate Bitcoin that can be traded on international markets. China, while publicly regulating crypto, continues to explore its strategic potential behind closed doors. In legitimizing Bitcoin through national adoption, the U.S. might enable rather than contain these activities. Moreover, the decentralized nature of the asset would prevent the U.S. from curbing its use by adversarial actors, essentially relinquishing a measure of control it currently enjoys through dollar-based financial systems. The dollar's role as the world's reserve currency underpins American economic and geopolitical power. It allows the U.S. to issue debt at lower costs, enforce sanctions, and influence global trade flows. Introducing Bitcoin into the national reserve risks undermining this system. Bitcoin's appeal lies in its independence from government control, but this same quality threatens the unified financial order that the dollar represents. Should the U.S. embrace a decentralized reserve asset, it signals a shift away from the very system that has afforded it unparalleled leverage. Such a shift could encourage other nations to diversify away from the dollar as well. The result could be a fragmented financial ecosystem in which U.S. influence is diluted. This risk is especially pronounced if Bitcoin becomes more widely adopted by nations seeking alternatives to dollar hegemony. In contrast to oil or rare earth metals, Bitcoin holds no intrinsic value in an emergency. It cannot power vehicles, manufacture electronics, or feed populations. Its utility is confined to digital transactions and speculative investments. While Bitcoin may be a useful hedge for individuals, it lacks the functional properties required of a strategic national reserve. It cannot serve as collateral in traditional ways, nor can it be quickly mobilized in a crisis without risking major market disruptions. In moments of national emergency, natural disasters, military conflicts, or economic crashes, the value of a speculative digital asset is questionable. In such contexts, traditional reserves provide immediate and tangible benefits. Bitcoin does not. Bitcoin's price history underscores its volatility. Swings of 30% or more within weeks are not uncommon. This makes it a risky asset for institutional investors, let alone national treasuries. The U.S. government, which manages trillions of dollars in assets, cannot afford to tie national financial health to such unpredictability. A dramatic drop in Bitcoin's value, such as the 70% decline between 2021 and 2022, would be politically and economically damaging. Volatility also undermines public trust. If taxpayer funds are used to accumulate Bitcoin, losses could trigger political backlash, media scrutiny, and calls for accountability. In times of economic uncertainty, this risk becomes especially pronounced. Even if Trump were to push aggressively for a Bitcoin reserve, institutional resistance would be immediate. The Federal Reserve has repeatedly signaled its reluctance to engage with decentralized cryptocurrencies. Under current law, the Fed is not authorized to hold Bitcoin. Changing this legal framework would require congressional approval, a daunting task in a politically divided environment. While Trump may enjoy support from certain Republican lawmakers, bipartisan consensus on crypto regulation remains elusive. Moreover, any proposed legislation would face intense debate over national security, financial stability, and ethical use of public funds. The Senate, with its procedural hurdles, makes sweeping financial reform difficult. A simple majority is not enough. Filibuster rules demand a 60-vote threshold, requiring cooperation across the aisle. Given the skepticism surrounding Bitcoin, especially among moderates and progressives, such support is unlikely. Public opinion on Bitcoin is sharply divided. While some view it as the future of finance, others associate it with speculation and illicit activity. Using taxpayer dollars to invest in such a polarizing asset carries significant political risk. During times of economic pressure, rising inflation, job insecurity, or debt concerns, voters tend to favor conservative fiscal policies. Proposing Bitcoin accumulation as a national strategy may be perceived as reckless or out of touch. This perception could erode support among centrist voters and fiscal conservatives. Trump's core base may appreciate his pro-crypto rhetoric, but national policy requires broader consensus. Without it, ambitious promises can quickly become political liabilities. Rather than adopt Bitcoin directly, a more feasible strategy for the U.S. would be the development of a central bank digital currency, CBDC, a crypto dollar. This digital asset, backed by the U.S. government, would retain the advantages of blockchain technology while preserving regulatory control. A crypto dollar could streamline payments, enhance cross-border transactions, and reinforce the dollar's global dominance. It would also offer better tools for AML, KYC, and sanction enforcement. Politically, it is more palatable as it avoids the ideological and practical conflicts posed by Bitcoin. Such an initiative would allow the U.S. to compete with China's digital yuan and other emerging CBDCs. It also aligns with broader digital transformation trends in the financial sector. Importantly, it offers a compromise between innovation and institutional integrity. Trump's Bitcoin pledge may ultimately be more rhetorical than actionable. Like many campaign promises, it serves a strategic function, mobilizing support, signaling innovation, and distinguishing his platform from traditional policymakers. Even if policy advisors caution against national Bitcoin adoption, Trump can maintain rhetorical support without taking concrete steps. Symbolic actions, such as creating task forces, holding summits, or funding blockchain research, may satisfy crypto enthusiasts while avoiding high-risk commitments. If the proposal stalls in Congress or faces bureaucratic delays, Trump could frame the issue as one of obstruction by the political establishment. This narrative allows him to retain credibility with supporters while distancing himself from policy outcomes. Faced with resistance from advisors, lawmakers, and institutions, Trump may quietly scale back his Bitcoin ambitions. Instead, he might focus on promoting private sector innovation, encouraging American leadership in blockchain, and challenging foreign digital currencies. Privately, his administration may even adopt a defensive posture, seeking to limit the influence of Bitcoin in global finance to protect the dollar. This could involve tighter regulations, international cooperation on crypto crime, and strategic investment in alternative technologies. Such a pivot would align more closely with traditional U.S. interests. It would also allow Trump to reframe his Bitcoin stance as a matter of national defense rather than economic experimentation. Trump's promise of a Bitcoin reserve taps into a broader desire for innovation and disruption in financial policy. Yet the practical barriers, economic, legal, institutional, and geopolitical, are too significant to ignore. Bitcoin may remain a useful talking point, but it is unlikely to become a central pillar of national strategy. In the long run, U.S. crypto policy will likely focus on regulatory modernization, blockchain innovation, and the development of a digital dollar. These paths offer greater control, strategic value, and political feasibility. While Bitcoin continues to reshape the financial landscape, its role in American government policy will likely remain symbolic rather than structural. Ultimately, the idea of a national Bitcoin reserve serves more as a mirror, reflecting the tensions between control and freedom, tradition and disruption, rhetoric and reality.